Hello, I'm Stephen Kelly. I'm a partner with K&O Worldwide. And today, this podcast, I want to talk on a topic that I gave at a Cracker Barrel recently at a professional conference in New York City. There was some great interest in it, and so I thought put it in this form so people could look at it as they wish. The subject of the talk was on, it's not how much you make, it's how much you keep. And it's looking at applying performance improvement methodologies to personal investments. And so in these next few minutes then, I want to kind of talk about this based on my experience. I am not at all involved or interested in selling any kind of particular stock or investment, but mainly some 12 principles of how you may want to approach this if you wish to become more active in managing your own investments. The way I learned about this topic, got into it, is during the 1990s, my partners and I were working in Central Europe, and we were quite successful. And what we found was we were putting all our energy into our business and keeping our clients satisfied, and putting the money in the bank in certificates of deposit at various levels of interest, just sitting there. And then at some point, I stepped back and was looking at this and think, well, I put so much energy into my business, but then I have this money that I've accumulated, these assets, and it's just sitting there. I don't put attention to it. And I experimented a little bit with finding financial advisors who would help me with this, but generally I felt I wasn't well served. So anyway, about 8 years ago, I decided that this stuff wasn't, as they say, brain surgery, that these guys were not any smarter than I was, and decided to put some time and energy into studying personal investment strategies and to begin actively managing my own assets. And based on that then are these 12 principles that I'm going to talk about today. You could call them the Kelly's rules of personal investing. But they're based on a lot of information that I've gained over the years from people such as Dennis Gartman, who is a well-known investment advisor and has certain rules, from the Oxford Club, which also has very good approaches to personal investing, as well as many other sources. So I can't claim these are original, but I think I put them together in a new way. And then as well, this is tied to my own profession. I'm a performance consultant. I help organizations or people improve performance. And so the methodologies I apply in my profession, I also apply to this. And in this case, four areas that I focus on. One is really focusing on outcomes, and outcomes from a general sense, from the point of view of my family unit and where we're trying to go in our own personal investment goals and growth of our assets. Along with this then is a systemic approach. I don't look at just one brokerage account or one particular asset, but look at everything together. And basically, as the title says, it's not what you make, it's what you keep at the end of the day, and focusing on growing that. Along with this then, it's a systematic, a step-by-step process of how to approach this. And then finally, it's developing partnerships. Partnerships that with advisors and other folks that gain value from both sides. On my side, from learning, and on their side, obviously, from making some income and money from this, but the right type of partnerships. So, given that then, let's start. The rule number one then is focusing on your total assets, rather than any one specific brokerage account or some cash deposits, these things. It's really looking at your family, whether that be you as an individual or the broader family, assets as a whole. And the way I do that is by just creating a very simple spreadsheet where I list these assets. And in this case, an asset is something like a house. Maybe it's a collectible jewelry that you might own, things that go up. Not a car, not things that depreciate or that are used up, not furniture or clothing, but certainly checking accounts, saving accounts, CDs, brokerage accounts, these types of assets, things that are of value to you. I basically just list these in a spreadsheet, total them up, And then basically once a month, then I track and update everything. Even though some things don't change very much, I update everything. And what I'm looking for then is that bottom line. At the end of the year, if I set a goal, has that asset, my total assets, moved up? And I am very conservative. I would like to be able to try to gain, if possible, 7 to 10% increase of what's remaining at the end of the year, each year. In other words, if I have $200,000 worth of assets, then after a year it would be nice at 7%, say I would have $214,000, $215,000. If I have $500,000 after a year, it would be nice to have $500,000 plus 7%, $535,000, setting these kind of goals. 7% doesn't sound like much, but it can be really, really a discipline to get this over an extended period of time. So, total assets looking at. Second thing then is, before getting involved in any active management of investments, it's absolutely necessary to pay off all of your high interest debt. Primarily I'm talking about credit cards or other types of financial loans that you have that are expensive. Most credit cards, once they're active, they're charging well over 10, 12%, sometimes 15, 18%. There's almost no way you're going to be able to get that kind of return on your personal investments that you're losing the other way. So you need to pay this off as a starting point. Otherwise, there's no sense putting money in other type of active investments, in my belief. And along with this then is, you don't want to be borrowing money on your house or other margin type accounts to then invest. It's always a risk. If you're paying interest on some money to invest it in something else, you can't be secure. If we're looking at 7-10% per year, that would be over a number of years, which means in some years you may have a negative, maybe a negative 2 or 3%. Other years you may get 10, 12, 15%. So you can't do short-term views on this. Now, third piece then, this is a very important part I discovered about active investing, is it's necessary to find the general trends that are going on, economic trends, first before you begin deciding how you want to place your individual investments. By a trend, I mean such things as, for example, currently there's a big growth in certain areas of commodities. Energy prices are going up, food, agricultural, metals, natural gas, water, these things are going up. It's an upward trend. You can see it over years. On a downsized trend, what you see is something like the US dollar. Over the past, well, since the early 70s, even longer, the dollar has been weakening steadily against other currencies and, of course, against gold, which is the ultimate measure of inflation. So dollars is not a good thing to hold, but for the time being, perhaps for the last 6 or 8 years, commodity type investments is a better thing to hold. If I look at the stock markets currently, the Dow Jones or the Standard & Poor's, those are very rocky. There's no sense of what the trend is, and so I generally would stay away from those. So anyway, there's these different kind of trends to consider. So identify it. And then what you want to do is try to identify the trends relatively early so that you can get into them. Because you can't always know the beginning, because impossible. But if you can get in 1/4 of the way up, then ride that trend almost 3/4, 4/5 up. Don't try to ride it to the very top, because that also is unpredictable. Then you can make your gains during that period of time. And most of these trends can end up lasting from 3 years to 5, 8 years. Often commodity trends have lasted 16 to 18 years. I mean, the dollar downturn has been going on now for 20, 30 years. So these trends continue over a longer period of time. And so you can identify them and move into them as early as possible. The good thing about trends is that if you can establish and understand the right trend, then anything that you purchase in an investment in that trend generally will go up. Because when the tide rises, all boats raise, and at the same time, if the tide's going down, all boats sink. This is not to say you can go out and buy any type of individual company. because that doesn't always work out. But there are ways, though, you can hedge your risk, you can manage your risk without focusing on individual companies. So this idea of trends, buying in early, once everyone is talking about how great something is, it's probably the time you want to be selling and looking for something that's generally hated. For instance, this is 2008. Currently, housing had been in a very long-term trend of going up. In fact, the last 5 or 6 years, extremely high until about a year ago. Now it seems to be in a downtrend, and probably that will last for a few years. Not a good time to be buying real estate currently. However, in 2 or 3 years, or at some point when people you meet are saying, I will never ever buy another house again in my life or a piece of real estate, and when the cover of Newsweek or Time is showing pictures of houses with bombs exploding on them or these sorts of things, it probably means that when everyone hates something, probably the bottom is pretty well there. Take a look at it. That's probably the time to begin looking at either buying real estate again, or even home builders or people who are involved in the real estate market. But early now, you want to wait till you start seeing some movement up. So, number 4 then, or actually 5, you want to manage your risk, which means diversifying. It means this, I mean this in several ways. One is diversification in terms of basically you don't want all your eggs in one basket. So this means keep some of your investment in cash or bonds, and bonds are simply types of loans from the government or other institutions that you buy that pay interest. Buy stocks is another part. You know, bonds / cash and stocks are too traditional, but you also can look at precious metal investments such as gold or commodities for a small part of your portfolio. So there's diversification that way, but even within something like cash, you don't need to hold only US dollars, since, as I noted, that's in a downward trend. So you can put your cash in Canadian funds, or perhaps into European funds, Euro or others. And you can do this in some ways by going to Europe or Canada to set up accounts. Or there are also tools, now I'll talk about in a minute, where you can actually do that within your brokerage account. Diversification also means institutions. Don't keep all your assets in one bank. Use several. Divide up your brokerage account if you have a huge amount of money in it. Divide it into several accounts. That means by geography as well, perhaps. Even though the Federal Deposit Insurance Company has 100,000 protection, in fact, that's 100,000 per person per institution. So if you have 300,000 or 400,000 in a bank, that is only protected 100,000, even if you have that divided into 4 or 5 big certificates of deposit. So diversify between institutions and geography as well, which I find even means getting outside of the continental USA and establishing things there. So diversify. And then even within certain, if you're buying stocks or bonds, that means look at different sectors, but keep in mind that you want to focus on the trend. And so looking at that general trend, you would want to buy more in there and you would want to stay away from either stocks or bonds in areas that are obviously currently going downhill, such as perhaps at this stage in 2008, some of the financials or the real estate or those sorts of things, and wait until they bottom out. So then you want to get independent financial advice, and this is this idea of partnerships. And by this I mean, primarily when I say independent, I mean that kind of advice that is given to you by a person who does not also sell you various types of investments, stocks or mutual funds or other things themselves. I mean advice from either 2 sources generally. One is you can subscribe to advisory newsletters from people who cover certain areas of investment, who are totally dependent on giving good advice because otherwise they lose subscribers. They don't sell any products to you, they only put out the advice. The other way, of course, is some people may prefer to have an individual financial advisor they can sit and talk with look at what's going on with their own personal situation. This is great, this is good, but at the same point, you do not want that person, though, to be the one who is selling you their own products, their stocks or their bonds. Many times we end up walking into a brokerage house or insurance company or something like this to get financial advice, and along with that we end up being offered various kinds of products that come from this company. And of course the company makes money on it, and the salesperson, I say broker, financial advisor, also is in the role of a salesperson then. They make their commissions whether what they've sold you goes up or down. So please really consider having good, independent financial advice if you feel that you need it, besides subscribing and being more active yourself. Then, looking now, number 7, don't fall in love with your investments. What do I mean here? I find a company, or maybe I'm sure that gold is going to go up, or oil is going to go up, and so I buy in, I've done my study, and in fact, it goes down. And so, but I'm in love, I'm sure I'm right. What do you do here? It's interesting that most people do psychologically the exact wrong thing. When they buy something, they establish a target for it to reach, and then if it reaches that, they sell it and get the profit. But at the same point, they buy something, it's not going up, it's going down. Often what they will do, instead of selling it fairly immediately to cut their loss, they will hope it will go back up so that they can sell it at a higher price. And in fact, it goes further down. Or if it goes back up, then they say, well, maybe, okay, I'll hold on to it for a while longer, and then it can also start going down. So they cut off their profits and often let their losses go much deeper than necessary. In fact, the proper way to do this is to have an exact 180-degree psychological approach, which means as you have things that are winning, you let those winners ride. Let those winners ride as high as they can go. You don't know how high that is going to be. Meanwhile, things that begin losing, that are going down, when you buy those, at the time you buy, you consider and establish a stopping point where if the thing sinks down to that point, you'll sell it no matter what, and then you'll wait 6 months before you look at it again. For instance, I buy a stock for $10. I then decide, for my comfort of mind, about a 20% stopping point is what I'm willing to take. I'm taking the risk of losing 20% and I'm hoping to gain maybe 100%. So that means on that $10 asset I bought, if it drops down to 8, a 20% dip, I sell it no matter what. Okay, trailing stop. Well, that's the stop. Then what you do is move into the idea of the trailing stop, which is, say this asset, this stock doubles to $20 from 10. So you've got 100% profit. What you do is, as that's going up, you keep your stop trailing behind it at 20%. So, for instance, when it's at $20, you still have the 20% trailing stop. So that means 20% of $20 is $4. So you have a $16 stop. If that item drops down to 16 at any point, you sell it. Therefore, you've locked in $6 of profit from your 10. But you also have left open the potential for it to go to 25 or 30. So this is the idea of the trailing stop. And it's useful and very important to establish this on all of your investments. You want to leave a wide enough margin for ups and downs, because all equities have up and down patterns if they're going up or if they're going down. So it's a question of how much risk you want. Most financial advisors talk about 15 to 25%. And in cases where people become quite nervous, then they might lower that to 5% or 10%. Very important concept, the trailing stop. You need to use it if you're investing. Size matters. You don't want to put a lot of your investments into too few types of selections. In fact, at the most, you should never have any one investment, other than maybe your house for many people, that's over 5% of your total assets. And in fact, in many cases, lower. And because the same point here is diversification, as I talked about, also in terms of size. If you have only a maximum of 5% of an investment, of something in a single investment, and so you keep a 20% trailing stop, that means is if you end up choosing wrong and you have that 5%, it loses its 20%, so it drops down to 4%. The most you can lose then is 1% of your assets. It's a hit, but it's not a big hit. So in this case, what I'm suggesting then is you would always have at least 20 different types of investment selections that you put in, and perhaps more. At the same point, as I said earlier, you're looking at general trends, and so you hopefully are picking those types of investments that are in those trends up or down, depending on how you're able to select what you want to do. A very important part of this is you want to try to avoid high fees. And fees come in many forms. Obviously there's brokerage fees for buying and selling things, but also in areas of traditional, for many years, mutual funds that are often held by brokerage or insurance companies or others. These particular funds are managed and often have relatively high fees of maybe 1.5% or 2% per year to handle this. And if you're looking to gain an investment of 7 to 10%, and you're paying up 1 or 2% on fees, it's quite expensive. And nowadays there are better ways to do that while still keeping diversification. One of the ways then you can do this is through the use of the new type of investment vehicle called exchange traded funds, ETFs. What these are very similar to the old mutual funds, except they're not actively managed. What they do is they represent a slice of the market. For example, if I'm interested in foreign stocks, I can buy an ETF, exchange traded fund, for the top 100 companies in China or the top 100 companies in Brazil. I could buy a ETF for representing oil or natural gas or wheat or anything. I can buy an ETF for the euros or the yen. And these things have very, very tiny expense rates, and at the same point you can buy and sell them like stocks. So there's no minimum period of holding on. If you've got an inexpensive brokerage trading cost, maybe $6, $8, you can buy $100,000 of this for $8. Very minimal cost. And what this allows you to do then is to get diversification as opposed to just buying a company. You can buy a group of energy companies, or you can buy a group of large consumer product companies. There are many of these. If you go to the web and type into ETF into any search engine, you will get a lot of information about all these types of funds. Very excellent way. Even some of them allow you choices. If you think something's going down, say you think that the stock market is going to go down, maybe the Dow Jones or the Standard & Poor's, they have ETFs you can buy that are reverse ETFs. In other words, if the Dow Jones goes down, you make money out of it. This thing goes up. So many, many choices now when you've done your homework and consider the trends, how to bet on these things without having to only focus on individual companies, which can be very dangerous unless you know them very well. So, very important part of this. Number 11 here, I'm talking about you need to keep an eye on taxes because paying taxes ultimately affects your results, but you can't drive your decisions based on taxes. I think, as everyone knows, is anytime you have something that's gone up quite a bit from where you paid for it, and you sell that profit, you have to pay a tax on, a capital gains tax. And so that is money taken away from your success there. At the same point, if you're selling things that hit your trailing stops, that money you lose then can be used to offset your capital gains. And so you can begin to balance these. The main point, you need to think about taxes, but don't let those taxes alone drive your decision making around buying and selling. And finally, the last piece I would suggest is, as you move into this and you look at your trends, focus on those things that you both understand and you find interesting. Because it's much easier than as an active investor to gather information and to make decisions. Like in my case, I have a history and an interest in precious metal stocks, gold and silver, platinum, these sorts of things. And so I've tended over the years now to become much more knowledgeable in these areas, and I tend to put a certain amount of my interest in those areas, and partly because the trend, once again I talked about trends earlier, in commodities, of which metals are, is in an uptrend, so it's a time where I can be active in those sorts of things. So you want to really pick things you're interested in and can understand. If you can't understand it, stay away from it. Most people, when you read about the people who became the multi-billionaires off of investments and stock trading, often these are people who really focused in a very narrow area. Maybe they were trading in cattle futures, or else they were working in certain currency trades or energy, and so they became expert in a small area and they basically rode that up and down, and that's how they made their money. So partly, all of us, we have so much time on our hands, we need to, and we can become specialized to things we enjoy and understand. But remember, you still have to diversify. You don't put all your eggs in one basket, but you can divide these up. You can buy these exchange-traded funds so that you have baskets of various types of bonds or stocks you're looking at. So, with this then, summarize briefly, you want to focus what? On total assets, not just individual narrow pieces. 2, you want to pay off high credit card debt others before you start. 3, then what? You want to identify the trends and try to get into them early. 4, well, actually, that's buying into these trends and making sure, wait till you see they're starting and then get out before they've gone too high. And once again, you can use trailing stops for this. You want to diversify your risk. 6, you want to get independent financial advice as required. 7, don't fall in love with your stock. Use the trailing stop technique, very, very important. 8, so you let your winners ride and then you cut your losses quickly. 9, size matters. Nothing greater than 5% any one investment of your assets. 10, you want to avoid high fees and old traditional mutual funds where possible, and use exchange-traded funds or closed-end funds, much cheaper and very easy to use today. 11, you want to manage your taxes. And finally, 12, focus on those things that you are interested in and understand. And I guess the final piece of this, if you do all these things that I've mentioned, you have to have patience. As an active investor, there's so much information coming in daily, you feel like you want to make moves with every ebb and flow of the market. No, if you're in the trend, the right trend, and you establish that and may monitor that, then let the ebbs and flows come and be patient and let it ride for some years. So, anyway, with that then, I hope this has been interesting for you. I hope that this will help you to keep more of what you've made. And with that, I will sign off. At the end of this, there will be an email address that you could write me if you would like to get a copy of the copy of the tips I've sent, as well as a couple of websites for getting what I consider good, unbiased investment advisory advice. So with that, have a good day, and thank you very much. Goodbye.